The number that should have been on every front page this week did not make most front pages. It was buried inside the Federal Reserve Bank of New York's quarterly report on household debt and credit, released in February 2026. And it describes something that the American financial system has not seen since the immediate aftermath of the 2008 financial crisis. And in one specific category, something it has never seen at all. Total American household debt hit $18.8 trillion at the end of the fourth quarter of 2025. Credit card debt alone hit $1.28 trillion, the highest balance since the New York Fed began tracking in 1999. That is $350 billion higher than the previous record set before the pandemic. And the 90-day plus delinquency rate on credit cards, the rate that measures people who are not just late but seriously behind, hit 12.4% in the third quarter of 2025. That is the highest level since 2011. It is nearly double the peak delinquency rate recorded during the entire 2008 financial crisis, which topped out at approximately 6.8%. Nearly double the financial crisis peak. On April 17, 2026, that number is sitting inside bank risk models, inside earnings calls, and inside regulatory filings that most Americans never read. And the banks are not being quiet about what they see coming. JP Morgan Chase, Wells Fargo, Citigroup, Goldman Sachs, and BlackRock all reported first quarter 2026 earnings this week. Every single one of them raised provisions for credit losses or increased reserves dramatically. Citigroup explicitly cited increased uncertainty in the macro outlook as the driver. Jamie Dimon published a statement warning of increasingly complex risks. And Bloomberg reported that the first quarter bank earnings showed, in its own words, strong growth alongside rising risk, with all 5 banks moving to more conservative reserve assumptions simultaneously. 5 of the largest banks in the world raising loss reserves at the same time is not a coincidence. It is a coordinated read on the same underlying data. And the underlying data is what this video is about. By the end of this video, you are going to understand exactly what the delinquency cliff is, why it is different from any previous consumer debt cycle America has experienced, what specific mechanism is causing 10 million accounts to light up in bank risk management systems right now, and what 3 outcomes the system is moving toward, only one of which does not involve severe damage to the American economy and to the financial lives of tens of millions of people. Because this is not just a story about people who overspent. This is a story about a structural trap that was set years before the people now falling into it ever made their first swipe. Let us start with this specific number that names the cliff, because the word delinquency sounds abstract until you understand exactly what it means in terms of actual human financial behavior and what it signals about everything that comes next. A credit card account becomes delinquent the first day after a payment is missed. That is 30-day delinquency. And 30-day delinquency has actually been declining, dropping to 2.94% in the fourth quarter of 2025. The headline delinquency numbers have been getting better for 6 consecutive quarters. The media reported this as progress, and in isolation, it is. But it is the wrong number to watch if you want to understand where the stress actually lives. The number you need to watch is the 90-day plus delinquency rate. 90 days means 3 consecutive missed payments. 90 days means the account has almost certainly been sent to collections, or is being internally flagged as a potential charge-off. 90 days means the borrower is not in a temporary cash crunch. The borrower is in a structural position where repayment is not happening and is unlikely to happen without a fundamental change in their financial circumstances. That rate hit 12.4% in the third quarter of 2025. 1 in every 8 credit card accounts in serious delinquency, nearly double the 2008 peak. And the 30-day rate improving while the 90-day rate is at crisis levels is not a contradiction. It is an explanation. The people who were in 30-day trouble a year ago are now in 90-day trouble. The short-term delinquency rate is improving because those borrowers have already graduated into the serious delinquency category. The pipeline that feeds the 90-day bucket is not slowing down. It is delivering. The improvement in the headline 30-day number is the system consuming its feedstock, not the system healing. Now let us build the full picture of why the 90-day bucket is this large, because the mechanism is specific, it is documented, and it did not happen by accident. Credit card balances in the United States were $770 billion in the first quarter of 2021. That was the bottom. The pandemic had temporarily depressed spending, stimulus checks had paid down balances, and the system had a brief moment of unusual credit health. From that bottom, credit card debt has risen by $507 billion, a 66% increase in less than 5 years. The debt did not rise because Americans suddenly became reckless. The debt rose because the cost of living outpaced income growth, and the credit card became the mechanism by which tens of millions of households bridged the gap. Here is the specific data point that tells you everything about what kind of debt this is. 55% of credit card balances in 2026 are being carried to cover essentials. not vacations, not electronics, not restaurant meals, groceries, rent, healthcare. More than half of the $1.28 trillion mountain of credit card debt is the accumulated cost of American households buying food and keeping the lights on with money they do not have, at an average annual percentage rate of 22.3%. To understand what 22.3% does to a household, consider the math on the average balance. The national average credit card balance among cardholders with unpaid balances is $7,886 as of the third quarter of 2025. At 22.3%, that balance costs approximately $1,759 per year in interest alone. That is $146 a month just to stand still, just to not pay down a single dollar of principal. The average 30-year mortgage rate right now is 6.8%. Auto loans run at 7.5%. A personal loan charges around 12%. The credit card charges 3 times what a mortgage costs on debt that the household accumulated buying groceries. And those new card offers being sent out right now average 23.77%. Not 22, 23.77. The rate is moving in the wrong direction at the same time that the balances are at record highs, and the 90-day delinquency rate is near crisis levels. This combination, rising principal, rising rate, falling ability to pay, is the specific geometry of a debt trap, and the trap is not evenly distributed across the American population. The distribution is where the real story lives. The New York Fed researchers described it directly in their February 2026 press call. They used a specific phrase. They called it a K-shaped economy. What that means in practice is this. The overall delinquency rate headline looks manageable because wealthy and higher income households are performing fine. They're paying their cards. Their balances are under control. When you average their performance with the performance of lower income households, the headline number looks moderate. But the averaging conceals what is actually happening in the lower half of the K. In low-income zip codes, delinquency rates are not declining, they are worsening. In Nevada, the state with the highest credit card delinquency rate in the country, the rate has reached 16.28%. 1 in every 6 credit card accounts in that state is in delinquency. In Mississippi, the average balance requires an estimated 22 months of dedicated payoff time. These are not outliers. They are the concentrated expression of a national pressure that the national averages dilute. And among specific demographic groups, the numbers are not moderate at all. Adults aged 18 to 29 are transitioning into 90-day credit card delinquency at roughly 3 times the rate of borrowers aged 60 to 69. Gen Z, the generation that was told to build credit, is being destroyed by credit. And for Gen Z specifically, shorter credit histories mean that late payments hit their credit scores disproportionately hard, raising future borrowing costs, making recovery slower, and creating this specific feedback loop where a financial mistake made at 22 years old makes the next decade of financial life systematically harder and more expensive. Now let us add the second layer, because the credit card crisis does not exist alone. It exists alongside 2 other simultaneous debt crises that are compounding on the same population at the same time. The student loan crisis, as of February 2026, has reached a level that analysts are describing as code red. Nearly 1 in 4 student loan borrowers with a payment due are now behind on their payments, 25%. That compares to approximately 9% before the pandemic pause began. 7.9 million borrowers entered delinquency in the first 3 quarters of 2025 alone. 9 million borrowers are in full default, the largest number of defaults on record. And according to the Century Foundation analysis published in February 2026, a borrower was falling into full default every 9 seconds during 2025. The specific mechanism behind the student loan explosion is policy-driven and well-documented. The pandemic payment pause lasted approximately 5 years. During that time, tens of millions of borrowers did not make a single student loan payment. Some used that time to pay down other debt. Many used it to fund consumption because the payment that had been consuming $300 to $500 a month was temporarily gone. When payments resumed, and then the income-driven repayment plans that had provided affordable payment options for millions of borrowers were eliminated or blocked. The monthly payment shock was catastrophic. The Institute for College Access and Success calculated that for the median American household, with a family of 4 and an income of $81,000, the monthly student loan payment could surge to $440 from $36 under the new repayment framework. $440. On a household that is already carrying an average credit card balance of $7,886 at 22% APR. The math does not work. And the math not working is why the delinquency cliff exists. The credit score damage from student loan delinquency has compounded the trap further. Delinquent student loan borrowers saw their credit scores drop by an average of 57 points in 2025. 3/4 of those borrowers fell into what analysts call deep subprime territory. Deep subprime borrowers cannot qualify for a mortgage. cannot qualify for a car loan at a reasonable rate, cannot rent an apartment in most cities, which require a 650 credit score just to apply, cannot get the kind of job that checks credit history as part of screening. One missed student loan payment chain running through the system does not just affect one debt. It affects the entire financial life of the person carrying it, potentially for years. And then there is the auto loan layer. Auto loan balances stood at $1.67 trillion at the end of the fourth quarter of 2025. Serious delinquencies in auto loans have been rising since the beginning of 2023. The car that a household bought at the peak of the pandemic-era supply shortage, when prices were elevated and loan terms stretched to maintain affordability, is now the same car whose payments are colliding with the resumed student loan payment, the elevated credit card minimum, and the grocery bill that has not come back down despite whatever the official inflation numbers say about the direction of price pressure. Three debt systems, credit cards, student loans, and auto loans, are in simultaneous deterioration for the same population of lower and middle income Americans. This is not three separate crises. This is one crisis expressed through three channels simultaneously. The channels are feeding each other. The household that misses a student loan payment absorbs a credit score hit that raises the rate on its next credit card, which raises the minimum payment, which makes the car payment harder to cover, which produces another missed payment, which deepens the credit score damage, which tightens access to every form of credit, at the moment when the household needs credit most urgently to bridge the gap that the debt service payments have created. That is the specific loop that has 10 million accounts lit up in bank risk management systems right now. And the banks are not passive observers of this loop. They are participants in it with their own risk exposure, which is why what they reported this week in first quarter earnings matters. All five major banks that reported earnings this week raised provisions for credit losses or increased reserves. What that means in practical terms is that the banks are setting aside money today to cover loans they expect will not be repaid. They are looking at their loan portfolios, running the 90-day delinquency data, running the student loan delinquency data, overlaying the bankruptcy filing trends, and concluding that a measurable additional amount of the money they have lent out is not coming back. The bankruptcy filing data confirms what the banks are modeling. In the first quarter of 2026, total U.S. bankruptcy filings rose 14% compared to the first quarter of 2025. Individual Chapter 7 cases, where assets are liquidated and debts discharged, increased 17% to 89,259 filings in Q1 alone. Chapter 13 filings, the restructuring track, rose 8% to 51,962. And the most alarming figure in the first quarter bankruptcy data was the small business category. Subchapter 5. Small business elections surged 67% from 499 to 833. Small businesses are failing at nearly twice the rate of a year ago. In March 2026 specifically, consumer bankruptcy filings totaled 52,171. A 16.79% increase from February alone. That is not a year-over-year number. That is 1 month to the next. The acceleration is not the alarming part in isolation. The alarming part is where this acceleration is starting from. Total individual bankruptcy filings in the year, ending September 2025, already topped 555,000 cases. In 2025, personal bankruptcy filings increased 12% over 2024. In Q1 2026, they increased another 14% over Q1 2025. This is a compounding acceleration, not a one-time adjustment. And the American Bankruptcy Institute's executive director, Amy Quackenboss, said it plainly. Persistent inflation, high interest rates, restricted credit, and global instability continue to compound the economic challenges of struggling families and small businesses. Now, let us address the specific question that everyone looking at this data eventually asks. Why is this happening now? The debt has been building for years. The rates have been high for years. The student loans were coming back since 2023. Why is the cliff specifically now, in April 2026, and not 2 years ago? The answer requires understanding three specific mechanisms that converged on the same timeline. The first mechanism is the on-ramp expiration. When student loan payments resumed in September 2023, the federal government created what it called an on-ramp period. During the on-ramp, missed student loan payments were not reported to credit bureaus. Borrowers who were not paying were shielded from the credit score consequences of not paying. That on-ramp expired in October 2024. The moment it expired, 5 years of accumulated non-payment behavior started hitting credit reports simultaneously. The credit score damage that would normally be distributed across 5 years of individual decisions was compressed into one period of mass credit reporting. Over 2.2 million borrowers saw their credit scores drop by more than 100 points in the first quarter of 2025 alone. That is not a normal distribution of individual financial distress. That is a policy event translated into a credit event, delivered to the banking system all at once. The second mechanism is the save plan elimination. The saving on a valuable education plan, which had been designed as the most affordable income-driven repayment option available to federal student loan borrowers, was challenged in court, blocked, and ultimately repealed. For the 8 million borrowers who were enrolled in SAVE, repayment terms that had been calibrated to their income were replaced by standard repayment terms calibrated to the size of the loan. The Institute for College Access and Success calculated that the median household monthly payment could surge from $36 to $440. That specific payment shock was not a gradual adjustment. It was a sudden increase delivered to 8 million households simultaneously, landing on top of credit card minimums already at record balances and auto loan payments already at record terms. The third mechanism is the interest rate environment that has not provided the relief the Federal Reserve suggested it would provide. The Fed made rate cuts in 2024. Those cuts did not translate into meaningfully lower credit card APRs because the spread between the federal funds rate and the credit card rate is not a fixed relationship. Banks absorb the rate cut in their margin rather than passing it to borrowers, particularly at a moment when their own credit loss provisions are rising. The average credit card APR was 22.3% in Q4 2025, not materially lower than where it was before the cuts. The borrower, who was promised that rate relief would help, is still paying 22% on a record balance, while the student loan payment just jumped from $36 to $440 a month. These three mechanisms did not arrive separately. They arrived together on the same households, in overlapping waves between late 2024 and mid-2025. The 90-day delinquency rate is not a measure of reckless spending. It is the measurement of what happens to a household's finances when three simultaneous policy changes, each independently designed to feel manageable, land on the same balance sheet at the same time. Now, let us address what the banks are actually planning to do with the accounts they have flagged, because the banks are not passive. They are making active decisions right now that will determine whether the delinquency cliff becomes a delinquency avalanche or whether it gets arrested at its current level. There are three possible outcomes. They are not equally likely, and they are not equally bad. Outcome one is the charge-off cycle. Banks take the accounts that are in serious delinquency, mark them as uncollectible, charge them off their books, and sell the debt to collections agencies at pennies on the dollar. The borrower gets a charge-off on their credit report that stays for 7 years. The credit score drops further. Access to credit narrows. The bank has cleared its books, but the household has been permanently downgraded in the financial system. This outcome is already happening. The charge-off rate eased slightly to 4.04% in Q2 2025 from the series peak set in Q1, but it remains at levels dramatically elevated relative to any historical normal outside of a recession period. The charge-off cycle is not a future risk. It is the present condition. Outcome two is a credit contraction. This is the outcome that keeps bank risk officers awake at night because it is the outcome that turns a consumer debt problem into a macroeconomic problem. Banks respond to elevated delinquency by tightening underwriting standards. They have already done this. The subprime origination share for new credit card accounts was reduced from 23.3% to 16.4% between Q1 2022 and Q1 2025. Banks are issuing fewer cards to risky borrowers. That means the households that most need access to credit to bridge the gap between income and essentials are the households being systematically excluded from getting it. The contraction of credit to the lower half of the K-shaped economy does not make those households more financially stable. It makes them more fragile because the credit card that was keeping the household functioning has been canceled or not renewed, and the gap it was bridging does not close when the credit closes. Credit contraction cascades through consumption. Households that cannot get credit cannot spend. Households that cannot spend reduce demand. Reduced demand hits revenue. Revenue decline hits employment. Employment decline hits income. Income decline produces more delinquency. This is the loop that transforms a debt cycle into a recessionary spiral. And it is the loop that 39% of lenders surveyed in the Proskauer 2026 Trends in Private Credit report believe the United States is either already in or will enter within the next 12 months. More than a quarter of those lenders said 2.5% or more of their own loan portfolio is already in default. Outcome three is the policy intervention outcome. This is the outcome where the federal government, the Federal Reserve, or both choose to intervene before the charge-off cycle and the credit contraction loop produce the macroeconomic consequences that outcome two describes. What that intervention looks like in practice is not publicly specified, but the general shape is identifiable from historical precedents. The Fed resumes quantitative easing in some form to provide banks with the liquidity to absorb losses without contracting credit simultaneously. The government introduces some mechanism for student loan relief that reduces the payment shock for the 8 million borrowers displaced from the SAVE plan. Credit card rate regulation, which has been discussed in Congress, becomes more urgent as the 22% APR environment is increasingly understood not as a market outcome, but as a policy choice that can be changed. The specific problem with outcome 3 is that each of the interventions required to execute it has a cost that the current political environment makes it very difficult to pay. Quantitative easing in an environment where consumer price inflation has not been fully extinguished risks reinflating the prices that produced the original cost of living crisis that drove the credit card balances to $1.28 trillion in the first place. Student loan relief has been judicially constrained, politically opposed, and policy reversed to the point where the 8 million displaced SAVE plan borrowers represent a constituency that has been told their relief is coming 4 separate times in 4 years and has not arrived. Credit card rate regulation requires congressional action in a Congress that is focused on other priorities. Outcome 3 is theoretically available. It is not currently being assembled. Now let us bring this to the level where it actually lives, because numbers this large can make the crisis feel abstract until you reduce it to the specific human size at which it is actually occurring. There is a woman in Nevada, because Nevada has the highest credit card delinquency rate in the country at 16.28%. She swiped a card at a grocery store last Tuesday, not because she did not plan, because the groceries cost $47 and the checking account had $31 in it, and the paycheck does not come until Friday. The $47 went on the card. The card is carrying a balance of $6,200. The minimum payment this month is $118. She paid $90 last month because the car registration had to be covered. That made the account 30 days late. The month before that, the student loan payment had just jumped from what had been $62 a month under the SAVE plan to $385 under the new standard repayment structure, and she had chosen the car insurance over both the student loan and the credit card. That was the month the 90-day clock started. Her account is now one of the 10 million that the bank's risk system has flagged. The bank is deciding this week, based on Q1 2026 earnings cycle protocols, whether to charge off the balance, reduce her credit limit, raise her APR to the penalty rate of 29.99%, or send the account to a collections team. Every one of those choices makes her financial situation worse than it was before they were made. Not because she is irresponsible, because the system charged her 22% to buy groceries on credit, while simultaneously removing the student loan repayment safety valve that had been providing $223 a month of breathing room in her budget. That is not a story about an individual financial decision. That is a story about 3 simultaneous policy choices that converged on one household in 1 month and produced one account in one bank's flagged portfolio. Multiply that story by 10 million and you have the delinquency cliff. Here is what the broader historical pattern tells us about what comes next, because the pattern is instructive in ways that the individual data points are not. Every major consumer debt cycle in American history has followed the same structural arc. The pandemic-era cycle of 2020 to 2021 suppressed debt through transfer payments and payment pauses. The 2015 to 2019 cycle was the longest sustained consumer debt expansion of the modern era, built on low rates and rising asset values that made the debt feel manageable. The 2008 to 2012 cycle was the crisis cycle where the debt came due simultaneously, and the financial system required emergency intervention to prevent collapse. The early 2000s cycle was the credit card expansion that preceded the tightening that preceded the housing crisis. In each cycle, the transition from the expansion phase to the reckoning phase has been marked by 2 specific indicators: rising serious delinquency preceding a wave of charge-offs and bankruptcies, and then a credit contraction that hits the borrowers who most need credit at the worst possible moment. Both of those indicators are present today. The 90-day delinquency rate at 12.4% is the leading indicator. The charge-offs already at 4.04% are the confirming indicator. The credit contraction already expressed in the reduction of subprime origination share from 23.3 to 16.4% is the downstream consequence. And the bankruptcy acceleration, 14% in Q1 2026 on top of 12% in all of 2025, is the final indicator that the transition from the expansion phase to the reckoning phase is not approaching. It has arrived. The specific insight that this cycle carries that previous cycles did not is the K-shaped character of the stress distribution. In 2008, the crisis was geographically concentrated first, then spread. In 2026, the crisis is income concentrated. It is not visible in the headline numbers because the headline numbers are being stabilized by the upper half of the K by households with substantial assets, secure employment, and access to credit that is not at 22% APR. The lower half of the K is experiencing a debt crisis that the upper half is not experiencing, and the headline averages are mathematically constructed in a way that makes the lower half's crisis look moderate. This is the specific danger of the moment. The headline numbers say the delinquency situation is improving. The 90-day rate says it is at crisis levels not seen since 2011. The headline says consumer spending is holding up. The student loan data says 7.9 million borrowers entered delinquency in 2025 alone. The headline says the banks are performing well. The banks themselves say they are raising loss provisions dramatically and modeling more conservative credit assumptions. The headline and the underlying data are not describing the same reality. The delinquency cliff is not on the front page because the people closest to the edge of it are the people whose financial distress is least visible to the people who write front pages. The $47 grocery purchase in Nevada is not a story that trades floors red. The 9 million student loan defaults are not a story that moves equity indices. The 14% bankruptcy acceleration is not a story that bank earnings calls feature prominently when the trading desks are booking record revenues. But the delinquency cliff is the story that matters for the specific reason that it is the story the banks just told each other this week in their earnings reports, in their provisions, in their reserves, and in their loss models. When JP Morgan, Wells Fargo, Goldman Sachs, Citigroup, and BlackRock each independently decide at the same moment that their credit loss reserves need to be larger, they are not making that decision based on the headline delinquency number. They are making it based on the 90-day rate, the charge-off trend, the student loan delinquency cascade, the bankruptcy acceleration, the same data this video has been walking through. The banks have red flagged the accounts. They are building the reserves. They are preparing for the losses. And the question that the Federal Reserve, the Congress, and every household carrying a balance at 22% needs to answer before the reserves get used is whether the cliff gets navigated with intervention, with managed contraction, or with a kind of unmanaged deterioration that turns a delinquency story into a recession story. The tools to navigate it are available. A rate environment that stops charging people 22% to buy food. A student loan system that does not deliver a $300 monthly payment shock to 8 million households simultaneously. A credit system that does not respond to distress by cutting off access to credit to the households most dependent on it. These are not radical interventions. They are the normal toolkit of a financial system that understands that consumer debt distress is not a moral failure to be punished with higher rates and credit contraction. It is a structural problem to be solved with structural tools. The delinquency cliff is not a metaphor. It is a measurement. 12.4% of credit card accounts 90 days or more past due. $1.28 trillion in total balances. 22.3% average APR. 9 million student loan defaults. 14% bankruptcy acceleration in the first quarter of 2026 alone. 10 million accounts flagged in bank risk systems right now. The cliff is not ahead of us. It is the ground we are standing on. The question of what happens next is being answered this week in bank boardrooms and in federal policy offices and in $47 grocery purchases in Nevada, all at the same time. The banks just told you what they see. The question is whether anyone who can do something about it is listening before the weight of 10 million flagged accounts tests the structure beneath the cliff.